A company form of organization is the third stage in the evolution of forms of organization. Its capital is contributed by a large number of persons called shareholders who are the real owners of the company. But neither it is possible for all of them to participate in the management of the company nor considered desirable. Therefore, they elect a board of directors as their representative to manage the affairs of the company. In fact, all the affairs of the company are governed by the provisions of the Companies Act, 2013. A company means a company incorporated or registered under the Companies Act, 2013 or under any other earlier Companies Acts. According to Chief Justice Marshall, a company is a person, artificial, invisible, intangible and existing only in the eyes of law. Being a mere creation of law, it possesses only those properties which the charter of its creation confers upon it, either expressly or as incidental to its very existence. A company usually raises its capital in the form of shares, called share capital, and debentures, debt capital. This chapter deals with the accounting for share capital of companies. 1.1 Features of a company. A company may be viewed as an association of persons who contribute money or money's worth to a common inventory and use it for a common purpose. It is an artificial person having corporate legal entity distinct from its members, shareholders, and has a common seal used for its signature. Thus, learning objectives. After studying this chapter, you will be able to explain the basic nature of a joint stock company as a form of business organization and the various kinds of companies based on liability of their members. Describe the types of shares issued by a company. Explain the accounting treatment of shares issued at par, at premium and at discount including oversubscription. Outline the accounting for forfeiture of shares and reissue of forfeited shares under varying situations. Work out the amounts to be transferred to capital reserve when forfeited shares are reissued. And prepare share forfeited account. Accounting for share capital 1. Rationalize 2023-24, 2 Accountancy, company accounts and analysis of financial statements. It has certain special features which distinguish it from the other forms of organization. These are as follows. Body corporate. A company is formed according to the provisions of law enforced from time to time. Generally, in India, the companies are formed and registered under companies law except in the case of banking and insurance companies for which a separate law is provided for. Separate legal entity. A company has a separate legal entity which is distinct and separate from its members. It can hold and deal with any type of property. It can enter into contracts and even open a bank account in its own name. Limited liability. The liability of the members of the company is limited to the extent of unpaid amount of the shares held by them. In the case of the companies limited by guarantee, the liability of its members is limited to the extent of the guarantee given by them in the event of the company being wound up. Perpetual succession. The company being an artificial person created by law continues to exist irrespective of the changes in its membership. A company can be terminated only through law. The death or insanity or insolvency of any member of the company in no way affects the existence of the company. Members may come and go but the company continues. Common seal. The company being an artificial person, cannot sign its name by itself. Therefore, every company is required to have its own seal which acts as official signatures of the company. Any document which does not carry the common seal of the company is not binding on the company. Transferability of shares. The shares of a public limited company are freely transferable. The permission of the company or the consent of any member of the company is not necessary for the transfer of shares. But the articles of the company can prescribe the manner in which the transfer of shares will be made. May sue or be sued. A company being a legal person can enter into contracts and can enforce the contractual rights against others. It can sue and be sued in its name if there is a breach of contract by the company. 1.2 Kinds of companies. Companies can be classified either on the basis of the liability of its members or on the basis of the number of members. On the basis of liability of its members, the companies can be classified into the following three categories. I. Companies limited by shares. In this case, the liability of its members is limited to the extent of the nominal value of shares held by them. If a member has paid the full amount of the shares, there is no liability on his part whatsoever, may be for the debts of the company. He need not pay a single paise from his private property. However, if there is Rationalized 2023-24 Accounting for Share Capital 3. Any liability involved, it can be enforced during the existence of the company as well as during the winding up. E. Companies limited by guarantee. In this case, the liability of its members is limited to the amount they undertake to contribute in the event of the company being wound up. Thus, the liability of the members will arise only in the event of its winding up. E. Unlimited companies. When there is no limit on the liability of its members, the company is called an unlimited company. When the company's property is not sufficient to pay off its debts, the private property of its members can be used for the purpose. In other words, the creditors can claim their dues from its members. Such companies are not found in India even though permitted by the Companies Act. On the basis of the number of members, companies can be divided into three categories as follows. I. Public company. A public company means a company which, A. is not a private company. B. is a company which is not a subsidiary of a private company. E. Private company. A private company is one which by its articles of association, A. restricts the right to transfer its shares. B. A private company must have at least two persons, except in case of one-person company. C. Limits the number of its members to 200, excluding its employees. E. One-person company, OPC, Sec. 262 of the Companies Act, 2013, defines OPC as a company which has only one person as a member. Rule 3 of the Companies Incorporation Rules, 2014 provides that only a natural person being an Indian citizen and resident in India can form one-person company. B. It cannot carry out non-banking financial investment activities. C. Its paid-up share capital is not more than Rs. 50 lakhs. D. Its average annual turnover of 3 years does not exceed Rs. 2 crores. 1.3 Share capital of a company. A company, being an artificial person, cannot generate its own capital which has necessarily to be collected from several persons. These persons are known as shareholders and the amount contributed by them is called share capital. Since the number of shareholders is very large, a separate capital account cannot be opened for each one of them. Hence, innumerable streams of capital contribution merge their identities in a common capital account called as share capital account. Rationalized 2023-24 Accountancy, Company Accounts and Analysis of Financial Statements. 1.3.1 Categories of share capital. From accounting point of view, the share capital of the company can be classified as follows. Authorized capital. Authorized capital is the amount of share capital which a company is authorized to issue by its Memorandum of Association. The company cannot raise more than the amount of capital as specified in the Memorandum of Association. It is also called nominal or registered capital. The authorized capital can be increased or decreased as per the procedure laid down in the Companies Act. It should be noted that the company need not issue the entire authorized capital for public subscription at a time. Depending upon its requirement, it may issue share capital, but in any case, it should not be more than the amount of authorized capital. Issued capital. It is that part of the authorized capital which is actually issued to the public for subscription, including the shares allotted to vendors and the signatories to the company's memorandum. The authorized capital which is not offered for public subscription is known as unissued capital. Unissued capital may be offered for public subscription at a later date. Subscribed capital. It is that part of the issued capital which has been actually subscribed by the public. When the shares offered for public subscription are subscribed fully by the public, the issued capital and subscribed capital would be the same. It may be noted that ultimately, the subscribed capital may be equal to or less than issued capital. In case the number of shares subscribed is less than what is offered, the company allots only the number of shares for which subscription has been received. In case it is higher than what is offered, the allotment will be equal to the offer. In other words, the fact of oversubscription is not reflected in the books. Called up capital. It is that part of the subscribed capital which has been called up on the shares, i.e., what the company has asked the shareholders to pay. The company may decide to call the entire amount or part of the face value of the shares. For example, if the face value, also called nominal value, of a share allotted is Rs. 10 and the company has called up only Rs. 7 per share, in that scenario, the called up capital 7 per share. The remaining Rs. The third of may be collected from its shareholders as and when needed. Paid up capital. It is that portion of the called up capital which has been actually received from the shareholders. When the shareholders have paid if any of the shareholders has not paid amount on calls, such an amount may be called as calls in arrears. Therefore, paid up capital is equal to the called up capital minus call in arrears. Uncalled capital, that portion of the subscribed capital which has not yet been called up. As stated earlier, the company may collect this amount any time when it needs further funds. Rationalized 2023-24 Accounting for Share Capital 5. Reserve capital. A company may reserve a portion of its uncalled capital to be called only in the event of winding up of the company. Such uncalled amount is called reserve capital of the company. It is available only for the creditors on winding up of the company. Authorized share capital. Issued capital, unissued capital. Subscribed capital. Subscribed and fully paid up, subscribed but not fully paid up. Exhibit 1.1 Categories of share capital. Let us take the following example and show how the share capital will be shown in the balance sheet. Sunrise Company Limited, New Delhi, has registered its capital as Rs. 4 million, divided into 400,000 shares of Rs. 10 each. The company offered to the public for subscription of 200,000 shares of Rs. 10 each, to be received as Rs. 2 on application, Rs. 3 on allotment, Rs. 3 on first call and the balance on final call. The company received applications for 250,000 shares. The company finalized the allotment of 200,000 shares and rejected applications for 50,000 shares. The company did not make the final call. The company received all the amount except on 2,000 shares where call money has not been received. The above amounts will be shown in the notes to accounts of the balance sheet of Sunrise Company Limited. As follows. Notes to accounts. Share capital, Rs. Authorized or registered or nominal capital. Achar and classes of shares. Shares refer to the units into which the total share capital of a company is divided. Thus, a share is a fractional part of the share capital and forms the basis of ownership interest in a company. The persons who contribute money through shares are called shareholders. The amount of authorized capital, together with the number of shares in which it is divided, is stated in the Memorandum of Association, but the classes of shares in which the company's capital is to be divided along with their respective rights and obligations, are prescribed by the Articles of Association of the company. As per the Companies Act, a company can issue two types of shares: 1. Preference shares, and 2. Equity shares, also called ordinary shares. 1.4.1 Preference shares. According to Section 43 of the Companies Act, 2013, a preference share is one which fulfills the following conditions. That it carries a preferential right to dividend to be paid either as a fixed amount payable to preference shareholders or an amount calculated by a fixed rate of the nominal value of each share before any dividend is paid to the equity shareholders. B. That with respect to capital it carries or will carry, on the winding up of the company, the preferential right to the repayment of capital before anything is paid to equity shareholders. However, notwithstanding the above two conditions, a holder of the preference share may have a right to participate fully or to a limited extent in the surpluses of the company as specified in the memorandum or articles of the company. Thus, the preference shares can be participating and non-participating. Similarly, these shares can be cumulative or non-cumulative, and redeemable or irredeemable. 1.4.2 Equity shares. According to Section 43 of the Companies Act, 2013, an equity share is a share which is not a preference share. In other words, shares which do not enjoy any preferential right in the payment of dividend or repayment of capital, are termed as equity, ordinary shares. The equity shareholders are entitled to share the distributable profits of the company after satisfying the dividend rights of the preference shareholders. The dividend on equity shares is not fixed and it may vary from year to year depending upon the amount of profits available. Rationalized 2023-24 Accounting for Share Capital 7. For distribution, the equity share capital may be I. With voting rights, or E. With differential rights as to voting, dividend, or otherwise in accordance with such rules and subject to such conditions as may be prescribed in the Articles of Association of the company. Test your understanding. I. State which of the following statements are true. A. A company is an artificial person. B. Shareholders of a company are liable for the acts of the company. C. Every member of a company is entitled to take part in its management. D. Company's shares are generally transferable. A. Share application account is a personal account. F. The director of a company must be a shareholder. G. Paid-up capital can exceed called-up capital. H. Capital reserves are created from capital profits. I. At the time of issue of shares, the maximum rate of securities premium is 10%. J. The part of capital which is called up only on winding up is called reserve capital. 1.5 Issue of shares. A salient characteristic of the capital of a company is that the amount on its shares can be gradually collected in easy installments spread over a period of time depending upon its growing financial requirement. The first installment is collected along with application and is thus known as application money, the second on allotment, termed as allotment money, and the remaining installments are termed as first call, second call, and so on. The word final is suffixed to the last installment. However, this in no way which prevents a company from calling the full amount on shares right at the time of application. The important steps in the procedure of share issue are: issue of prospectus. The company first issues the prospectus to the public. Prospectus is an invitation to the public that a new company has come into existence and it needs funds for doing business. It contains complete information about the company and the manner in which the money is to be collected from the prospective investors. Receipt of applications. When prospectus is issued to the public, prospective investors intending to subscribe the share capital of the company would make an application along with the application money. Rationalized 2023-24, 8 Accountancy, company accounts and analysis of financial statements. and deposit the same with a scheduled bank as specified in the prospectus. The company has to get minimum subscription within 120 days from the date of the issue of the prospectus. If the company fails to receive the same within the said period, the company cannot proceed for the allotment of shares and application money should be returned within 130 days of the date of issue of prospectus. Allotment of shares. If minimum subscription has been received, the company may proceed for the allotment of shares after fulfilling certain other legal formalities. Letters of allotment are sent to those whom the shares have been allotted, and letters of regret to those to whom no allotment has been made. When allotment is made, it results in a valid contract between the company and the applicants who now became the shareholders of the company. Minimum subscription. The minimum amount that, in the opinion of directors, must be raised to meet the needs of business operations or to be purchased, which has to be met wholly or partly out of the proceeds of issue. Preliminary expenses payable by the company and any commission payable in connection with the issue of shares. The repayment of any money borrowed by the company for the above two matters. Working capital. And any other expenditure required for the usual conduct of business operations. It is to be noted that minimum subscription of capital cannot be less than 90% of the issued amount according to SEBI Disclosure and Investor Protection Guidelines 2000 6.3.8.1 and 6.3.8.2. If this condition is not satisfied, the company shall forthwith refund the entire subscription amount received. If a delay occurs beyond 8 days from the date of closure of subscription list, the company shall be liable to pay the amount with interest at the rate of 15%, Section 73(2). Shares of a company are issued either at par or at a premium. Shares are to be issued at par when their issue price is exactly equal to their nominal value according to the terms and conditions of issue. When the shares of a company are issued more than its nominal value, face value, the excess amount is called premium. Rationalized 2023-24 Accounting for Share Capital 9. Irrespective of the fact that shares are issued at par or at a premium, the share capital of a company as stated earlier, may be collected in installments payable at different stages. 1.6 Accounting treatment on application. The amount of money paid with various installment represents the contribution to share capital and should ultimately be credited to share capital. However, for the sake of convenience, initially individual accounts are opened for each installment. All money received along with application is deposited with a scheduled bank in a separate account opened for the purpose. The journal entry is as follows: Bank A, C Drive. To share application A, C, amount received on application for shares at Rs. Per share, on allotment, when minimum subscription has been received and certain legal formalities on the allotment of shares have been duly compiled with, the directors of the company proceed to make the allotment of shares. The allotment of shares implies a contract between the company and the applicants who now become the allotees and assume the status of shareholders or members. Allotment of shares, implications from accounting point of view. It is customary to ask for some amount called allotment money from the allotees on the shares allotted to them as soon as the allotment is made. With the acceptance to the offer made by the applicants, the amount of application money received has to be transferred to share capital account as it has formally become the part of the same. The money received on rejected applications should be fully returned to the applicant within period prescribed by law, SEBI. In case lesser number of shares have to be allotted, then those applied for the excess application money must be adjusted towards the amount due on allotment from the allotees. The effect of the later two steps is to close the share application account, which is only a temporary account for share capital transactions. Rationalized 2023-24-10 Accountancy, company accounts and analysis of financial statements. The journal entries with regard to allotment of shares are as follows. 1. For transfer of application money, share application A, C drive. To share capital A, C, application money on _ shares allotted, transferred to share capital. 2. For money refunded on rejected application, share application A, C drive. To bank A, C, application money returned on rejected application for _ shares. 3. For amount due on allotment, share allotment A, C drive. To share capital A, C. 4. For adjustment of excess application money, share application A, C drive. To share allotment A, C, application money on _ shares at Rs _ per shares. Sometimes a combined account for share application and share allotment, called share application and allotment account, is opened in the books of a company. The combined account is based on the reasoning that allotment without application is impossible, while application without allotment is meaningless. These two stages of share capital are closely interrelated. When a combined account is maintained, journal entries are recorded in the following manner. Rationalized 2023-24 accounting for share capital 11. 1. For receipt of application and allotment, bank A, C drive. To share application and allotment A, C, money received on applications for shares at Rs per share. 2. For transfer of application money and allotment amount due, share application and allotment A, C drive. To share capital A, C, transfer of application. Liquidations supported by blocked amount, ASBA, initial public offers and rights issues, etc. Of securities, shares, debentures or other financial instruments, may be subscribed by paying application money by a banking instrument, check, pay order, draft, debit to bank account, or through applications supported blocked amount, ASBA. ASBA is one of the methods for payment of application money. ASBA is a process developed by Securities and Exchange Board of India, SEBI, to apply for subscribing to IPOs and rights issue, etc. Of securities. Under the method, the applicant authorizes the bank to block the bank account for the application money, for subscribing the issue. The bank debits the applicant's account with application money only if he, she is allotted securities, shares, debentures, etc. for the amount payable on allotted securities. In case securities are not allotted, the bank removes the block, lien, on the amount. Under ASBA-based applications, application amount payable on the securities applied is blocked by the bank, i.e., it marks a lien on amount payable as application money on securities applied. After the company has allotted securities, bank debits the applicant's bank account by the amount payable on allotted securities and remove the lien on the balance amount. Rationalized 2023-24-12 Accountancy, Company Accounts and Analysis of Financial Statements. On calls. Calls play a vital role in making shares fully paid up and for realizing the full amount of shares from the shareholders. In the event of shares not being fully called up till the completion of allotment, the directors have the authority to ask for the remaining amount on shares as and when they decide about the same. It is also possible that the timing of the payment of calls by the shareholders is determined at the time of share issue itself and given in the prospectus. 2 points are important regarding the calls on shares. First, the amount on any call should not exceed 25% of the face value of shares. Second, there must be an interval of at least 1 month between the making of 2 calls unless otherwise provided by the Articles of Association of the company. When a call is made and the amount of the same is received, the journal entries are as given below. 1. For call amount due, share call A, C drive. To share capital A, C, call money due on _ shares at Rs. Per share, 2. For receipt of call amount bank A, C drive. To share call A, C, call money received. The words first, second, or third must be added between the words share and call in the share call account depending upon the identity of the call made. For example, in case of first call it will be termed as share first call account, in case of second call it will be share second call account, and so on. Another point to be noted is that the words and final will also be added to the last call. Say, if second call is the last call it will be termed as second and final call, and if it is the third call which is the last call, it will be termed as third and final call. It is also possible that the whole balance after allotment may be collected in one call only. In that case the first call itself shall be termed as the first and final call. The following points should be kept in mind while issuing the share capital for public subscription. 1. The application money should be at least 5% of the face value of the share. 2. Calls are to be made as per the provisions of the Articles of Association. 3. Where there is no Articles of Association of its own, the following provisions of Table A will apply. A period of 1 month must elapse between 2 calls. B. The amount of call should not exceed 25% of the face value of the share. Rationalized 2023-24 Accounting for Share Capital 13. C. A minimum of 14 days notice is given to the shareholders to pay the amount. And D. Calls must be made on a uniform basis on all shares within the same class. 4. The procedure for accounting for the issue of both equity and preference shares is the same. To differentiate between the two, the words equity and preference is prefixed to each and every installment. Illustration 1. Mona Earth Mover Limited decided to issue 12,000 shares of Rs. 100 each payable at Rs. 30 on application, Rs. 40 on allotment, Rs. 20 on first call and balance on second and final call. Applications were received for 13,000 shares. The directors decided to reject application of 1,000 shares and their application money being refunded in full. The allotment money was duly received on all the shares, and all sums due on calls are received except on 100 shares. Record the transactions in the books of Mona Earth Movers Limited. Solution. Books of Mona Earth Mover Limited. Journal. Date particulars LF debit credit. Amount Rs. Rs. Bank A, C Dr. 309. Calls in arrears. It may happen that shareholders do not pay the call amount on due date. When any shareholder fails to pay the amount due on allotment or on any of the calls, such amount is known as calls in arrears, unpaid calls. Calls in arrears represent the debit balance of all the calls account. Such amount shall appear as Note to Accounts, refer Chapter 3. However, where a company maintains calls in arrears account, it needs to pass the following additional journal entry: calls in arrears A, C drive. To share first call account A, C to share second and final call account A, C, calls in arrears brought into account. The Articles of Association of a company may empower the directors to charge interest at a stipulated rate on calls in arrears. If the articles are silent in this regard, the rule contained in Table F shall be applicable, which states that the interest at a rate not exceeding 10% p.a. shall have to be paid on all unpaid amounts on shares for the period intervening between the day fixed for payment and the time of actual payment thereof. On receipt of the call amount together with interest, the amount of interest shall be credited to interest account, while call money shall be credited to the respective call account or to calls in arrears account. When the shareholder makes the payment of calls in arrears together with interest, the entry will be as follows: Bank A, C Drive. To calls in arrears A, C to interest on calls in arrears A, C, calls in arrears received with interest. Note, if nothing, calls in advance. Sometimes shareholders pay a part or the whole of the amount of the calls not yet made. The amount so received from the shareholders is known as calls in advance. The amount received in advance is a liability of the company and should be credited to call in advance account. The amount received will be adjusted towards the payment of calls as and when they becomes due. Table F of the Companies Act provides for the payment of interest on calls in advance at a rate not exceeding 12% per annum. The following journal entry is recorded for the amount of calls received in advance. Bank A, C Drive. To calls in advance A, C, amount received on call in advance. On the due date of the calls, the amount of calls in advance is adjusted by the following entry: calls in advance A, C Drive. To particular call A, C, calls in advance adjusted with the call money due, the balance in calls in advance account is shown as a separate item under the title Equity and Liabilities in the company's balance sheet under the head Current Liabilities, as subhead Others Current Liabilities. It is not added to the amount of paid up capital. As calls in advance is a liability of the company, it is under obligation, if provided by the articles, to pay interest on such amount from the date of its receipt up to the date when appropriate call is due for payment. A stipulation is generally made in the articles regarding the rate at which interest is payable. However, if articles are silent on this account, Table F is applicable, which provides for interest on calls in advance at a rate not exceeding 12% per annum. The accounting treatment of interest on calls in advance is as follows: 1. For payment of interest on calls in advance A, C Drive. To Bank A, C, interest paid on calls in advance. OR. 2. A. For interest due interest on calls in advance A, C Drive. To sundry shareholders A, C, interest paid on calls in advance. 2. B. For interest paid sundry shareholders A, C Drive. To Bank A, C. Rationalized 2023-24 Accounting for Share Capital 19. Illustration 4. Conacher Limited registered with an authorized equity capital of Rs. 200,000 divided into 2,000 shares of Rs. 100 each, issued for subscription of 1,000 shares payable at Rs. 25 per share on application, Rs. 30 per share on allotment, Rs. 20 per share on first call and the balance as and when required. Application money on 1,000 shares was duly received and allotment was made to them. The allotment amount was received in full, but when the first call was made, one shareholder failed to pay the amount on 100 shares held by him and another shareholder with 50 shares paid the entire amount on his shares. The company did not make any other call. Give the necessary journal entries in the books of the company to record these share oversubscription. There are instances when applications for more shares of a company are received than the number offered to the public for subscription. This usually happens in respect of shares issue of well-managed and financially strong companies and is said to be a case of oversubscription. In such a condition, three alternatives are available to the directors to deal with the situation. 1. They can accept some applications in full and totally reject the others. 2. They can make a pro rata allotment to all. And 3. They can adopt a combination of the above two alternatives, which happens to be the most common course adopted in practice. The problem of oversubscription is resolved with the allotment of shares. Therefore, from the accounting point of view, it is better to place the situation of oversubscription within the total frame of application and allotment, i.e., receipt of application amount, amount due on allotment and its receipt from the shareholders, and the same has been observed in the pattern of entries. First alternative. When the directors decide to fully accept some applications and totally reject the others, the application money received on rejected applications is fully refunded. For example, a company invited applications for 20,000 shares and received the applications for 25,000 shares. The directors rejected the applications for 5,000 shares which are in excess of the required number and refunded their application money in full. In this case, the journal entries on application and allotment will be as follows. The journal entries on application and allotment according to this alternative are as follows. 1. Bank A, C Drive. To share application A, C, money received on application for 25,000 shares at Rs. Per share. To share application A, C Drive. To share capital A, C to Bank A, C, transfer of application for money 20,000 for shares allotted and money refunded on applications for 5,000 shares rejected. 3. Share allotment A. Alternative. When the directors opt to rationalize 2023-24 accounting for share capital 25. Second alternative. When the directors opt to make a proportionate allotment to all applicants, called pro rata allotment, the excess application money received is normally adjusted towards the amount due on allotment. In case the excess application money received is more than the amount due on allotment of shares, such excess amount may either be refunded or credited to calls in advance. For example, in the event of applications for 20,000 shares being invited and those received are for 25,000 shares, it is decided to allot shares in the ratio of 4:5 to all applicants. It is a case of pro rata allotment and the excess application money received on 5,000 shares would be adjusted towards the amount due on the allotment of 20,000 shares. In this case, the journal entries on application and allotment will be as follows. Third alternative. When the application for some shares are rejected outrightly, and pro rata allotment is made to the remaining applicants, the money on rejected applications is refunded and the excess application money received from applicants to whom pro rata allotment has been made is adjusted towards the amount due on the allotment of shares allotted. For example, a company invited applications for 10,000 shares and received applications for 15,000 shares. The directors decided to reject the applications for 2,500 shares outright and to make a pro rata allotment of 10,000 shares to the applicants for the remaining 12,500 shares so that 4 shares are allotted. Undersubscription is a situation where number of shares applied for is less than the number for which applications have been invited for subscription. For example, a company offered 2 lakh shares for subscription to the public but the applications were received for 190,000 shares only. In such a situation, the allotment will be confirmed to 190,000 shares and entries shall be made accordingly. However, as stated earlier, it must be ensured that the company has received the minimum subscriptions and the company will have to refund the entire subscription amount received. 1.6.5 Issue of shares at a premium. It is quite common for the shares of financially strong and well-managed companies to be issued at a premium, i.e. at an amount more than the nominal or par value of shares. Thus, when a share of the nominal value of Rs. 100 is issued at Rs. 105, it is said to have been issued at a premium of 5%. When the issue of shares is at a premium, the amount of premium may technically be called at any stage of the issue of shares. However, premium is generally called with the amount due on allotment, sometimes with the application money and rarely with the call money. The premium amount is credited to a separate account called Securities Premium Account and is rationalized 2023-24 accounting for share capital 31. Shown under the title, Equity and Liabilities of the company's balance sheet under the head, Reserves and Surpluses. It can be used only for the following 5 purposes. A. To issue fully paid bonus shares to the extent not exceeding unissued share capital of the company. B. To write off preliminary expenses of the company. C. To write off the expenses of, or commission paid, or discount allowed on any securities of the company. And D. To pay premium on the redemption of preference shares or debentures of the company. A. Purchase of its own shares, i.e., buyback of shares. The journal entries for shares issued at a premium are as follows. 1. For premium amount called with application money, A. Bank A, C drive. To share application A, C, money received on application for shares at Rs. Per share including premium, B, share application A, C drive. To share capital A, C to securities premium reserve A, C, transfer of application money to share capital and securities premium account, 2. Premium amount called with allotment money, A, share allotment A, C drive. To share capital A, C to securities premium reserve A, C, amount due on allotment of shares at Rs, per share including premium, B, Bank A, C drive. To share allotment A, C, allotment money received including premium, 3. Premium amount called with call money, A, share application A, C to share capital reserve A, C to securities premium A, C, amount due on first, second call at Rs, per share including premium, B, Bank A, C drive. To share call A, C, call money received including premium. Rationalized 2023-24-32 Accountancy, Company Accounts and Analysis of Financial Statements. Illustration 8. Jupiter Company Limited issued 35,000 equity shares of Rs. 10 each at a premium of Rs. 2 payable as follows, on application Rs. 3 on allotment Rs. 5, including premium, balance on first and final call. The issue was fully subscribed. All the money was duly received. Record journal entries in the books of the company. Solution. Books of Jupiter Company Limited Journal. Issue of shares at a discount. There are instances when the shares of a company are issued at a discount, i.e., at an amount less than the nominal or par value of shares, the difference between the nominal value and issue price representing discount on the issue of shares. For example, when a share of the nominal value of Rs. 100 is issued at Rs. 98, it is said to have been issued at a discount of 2%. As a general rule, a company cannot ordinarily issue shares at a discount. It can do so only in cases such as reissue of forfeited shares, to be discussed later, and issue of sweat equity shares. 1.6.7 Issue of shares for consideration other than cash. There are instances where a company enters into an arrangement with the vendors from whom it has purchased assets, whereby the latter agrees to accept the payment in the form of fully paid shares of the company issued to them. Normally, no such cash is received for issue of shares. These shares can also be issued either at par, at premium or at discount, and the number of shares to be issued will depend upon the price at which the shares are issued and the amount payable to the vendor. The number of shares to be issued to the vendor will be calculated as follows. Number of shares to be issued equals amount payable. Issue price. For example, Rahul Limited purchased building from Hunter Limited for Rs. 540,000 and the payment is to be made by the issue of shares of Rs. 100 each. The number of shares to be issued shall be worked out as follows in different situations. A. When shares are issued at par, i.e., at Rs. 100. Amount payable. Number of shares to be issued. Issue price. Rs. 540,000. Est your understanding, 2. Choose the correct answer. A. Equity shareholders are I. Creditors, E. Owners, E. Customers of the company, IV. None of the above. B. Nominal share capital is I. That part of the authorized capital which is issued by the company. E. The amount of capital which is actually applied for by the prospective shareholders. E. The maximum amount of share capital which a company is authorized to issue. IV. The amount actually paid by the shareholders. C. Interest on calls in arrears is charged according to Table F at I. 10%, E. 6%, E. 8%, IV. 11%, D. Money received in advance from shareholders before it is actually called up by the directors as I. Debited to calls in advance account, E. Credited to calls in advance account. Rationalized 2023-24-36 Accountancy, Company Accounts and Analysis of Financial Statements. E. Debited to calls account, IV. None of the above. A. Shares can be forfeited. I. For non-payment of call money. E. For failure to attend meetings. E. For failure to repay the loan to the bank. IV. For which shares are pledged as a security. F. The profit on reissue of forfeited shares is transferred to I. General Reserve. E. Capital Redemption Reserve. E. Capital Reserve. IV. Revenue Reserve. G. Balance of share forfeiture account is shown in the balance sheet under the item I. Current liabilities and provisions. E. Reserves and surpluses. E. Share capital. IV. Unsecured loans. Private placement of shares. The Companies Act, 2013, Section 42, describes private placement as an offer of securities or invitation to subscribe securities to a select group of persons through issue of private placement offer letter. Employees Stock Option Plan, ESOP. A company may offer option to its employees and employ directors to subscribe shares of the company at lower than its market value or fair value at a future date. It is known as Employees Stock Option Plan, ESOP. It being an option granted by the company, an employee may or may not exercise the Employees Stock Option may offer option to its employees and employ date. It is Employees Stock Option Plan, ESOP. A company may offer option to its employees and employ directors to subscribe shares of the company at lower than its market value or fair value at a future date. It is known as Employees Stock Option Plan, ESOP. It being an option granted by the company, an employee may or may not exercise the right to subscribe. Employees Stock Option Plan falls in the category of sweat equity being a wider. A company issuing the options has to fulfill following prescribed conditions. These shares are of the same class of shares already issued. B. It is authorized by a special resolution passed by the company. C. The resolution specifies the number of shares, the current market price, consideration, if any, and the class or classes of directors or employees to whom such equity shares are to be issued. D. Not less than 1 year has, at the date of issue, elapsed since the date on which the company had commenced business. And A. These shares are issued in accordance with SEBI regulations, if the shares are listed. Important terms of ESOP grant. Grant means giving an option to the employees to subscribe to the shares of the company at the predetermined price. Rationalized 2023-24 Accounting for Share Capital 37. Grant date. It is the date of agreement between the enterprise and its employees to the terms of Employees Stock Option Plan, ESOP. Vesting. A process to give right to employees to apply for shares of the company. Vesting date. It is the date on which the employee becomes entitled to apply for the shares once he has satisfied the vesting conditions. Vesting period. The period between the grant date and the date on which all the specified vesting conditions of an employee's stock option plan, ESOP, need to be satisfied. Exercise. It means applying by the employee for issue of shares against the option vested in him. Exercise period, period after vesting within which the employee must exercise the right to apply for shares against the option vested in him in pursuance of the employee's stock option plan. Exercise price, the price payable by the employee for exercising the option granted in pursuance of the employee's stock option plan. Value of option, difference between the market price and the issue price of the security. 1.7 Forfeiture of shares. It may happen that some shareholders fail to pay one or more installments, viz. allotment money and/or call money. In such circumstances, the company can forfeit their shares, i.e., cancel their allotment and treat the amount already received thereon as forfeited to the company within the framework of the provisions in its articles. These provisions are usually based on Table F, which authorize the directors to forfeit the shares for non-payment of calls made. For this purpose, they have to strictly follow the procedure laid down in this regard. Following is the accounting treatment of shares issued at par, premium, or at a discount. When shares are forfeited, all entries relating to the shares forfeited except those relating to premium, already recorded in the accounting records, must be reversed. Accordingly, share capital account is debited with the amount called up in respect of shares are forfeited and crediting the respective unpaid calls accounts or calls in arrears account with the amount already received. Thus, the journal entry will be as follows. A. Forfeiture of shares issued at par, share capital A, C. Called up amount, drive. To share forfeiture A, C. Paid up amount, to share allotment A, C to share calls A, C, individually. Shares forfeited for non-payment of allotment money and calls made. Rationalized 2023-24-38 Accountancy, Company Accounts and Analysis of Financial Statements. It may be noted here that when the shares are forfeited, all entries relating to the forfeited shares must be reversed except the entry relating to share premium received, if any. Accordingly, the share capital is debited to the extent to called up capital and credited to I, respective unpaid calls account, i.e., calls in arrears, and E, share forfeiture account with the amount already received on shares. The balance of shares forfeited account is shown as an addition to the total paid up capital of the company under the head, Share Capital, under title, Equity and Liabilities of the balance sheet till the forfeited shares are reissued. Illustration 10. Honda Limited issued 10,000 equity shares of 100 each payable as follows, Rs. 20 on application, Rs. 30 on allotment, Rs. 20 on first call and Rs. 30 on second and final calls. 10,000 shares were applied for and allotted. All money due was received with the exception of both calls on 300 shares held by Supriya. These shares were forfeited. Give necessary journal entries. Solution. Books of Honda Limited Journal. Date particulars LF debit credit. Amount Rs. Rs. Bank A, C Dr. 200,000 to equity share application A, C 200,000, application money on 10,000 shares at Rs. 20 per share received, share application A, C Dr. 200,000 to equity share capital A, C 200,000, application money transferred to share capital, share allotment A, C Dr. 300,000 to equity share capital A, C 300,000, money due on allotment of 10,000 shares at Rs. 30 per share, Bank A, C Dr. 300,000 to equity share allotment A, C 300,000, allotment money received on 10,000 shares at Rs. 30 per share on. Rationalized 2023-24 Accounting for Share Capital 39. Share first call A, C Dr. 200,000 to equity share capital A, C 200,000, money due on 10,000 shares at Rs. 20 per share on first call, Bank A, C Dr. 194,000 to equity share first call A, C 194,000, first call money received except for 300 shares, share second and final call A, C Dr. 300,000 to equity share capital A, C 300,000, money due on 10,000 shares at Rs. 30 per share on second and final call. Bank A, C Dr. 291,000 to equity share second and final call A, C 291,000, second and final call money received except for 300 shares. Share capital A, C Dr. 30,000 to equity share first call A, C 6,000 to equity share second and final call A, C 9,000 to share forfeiture A, C 15,000, 300 shares forfeited. Forfeiture of shares issued at a premium. If shares were initially issued at a premium and the premium amount has been fully realized, but some of the shares are forfeited due to non-payment of call money, the accounting treatment for forfeiture shall be on the same pattern as in the case of shares issued at par. The important point to be noted in this context is that the securities premium account is not to be debited at the time of forfeiture if the premium has been received in respect of the forfeited shares, and the amount of forfeiture shall be excluding premium amount. In case, however, if the premium amount has not been received, either wholly or partially, in respect of the shares forfeited, the securities premium reserve account will also be debited with the amount of premium not received along with the share capital account at the time forfeiture. This will usually be the case when even the amount due on allotment has not been received. Thus, the journal entry to record the forfeiture of shares issued at a premium on which premium has not been fully received will be share capital A, C drive. Securities Premium Reserve A, C drive. To share forfeiture A, C. Rationalized 2023-24, 40 Accountancy, Company Accounts and Analysis of Financial Statements. To share allotment A, C and or to share calls A, C, individually. Shares forfeited for non-payment of allotment money and calls made. Note, if calls in arrears account is maintained, calls in arrears account is credited and not the share allotment and or share calls accounts. Illustration 11. Sahil, a shareholder, failed to pay the money for second and final call of Rs. 20 on 1000 shares issued to him at Rs. 120, face value of Rs. 100 per share. His shares were forfeited after the second and final call. Give the necessary journal entry for forfeiture of the shares. Solution. Date particulars LF debit credit. Amount Rs. Share capital A, C Dr. 100,000 to share second and final call A, C 20,000 to share forfeiture A, C 80,000 forfeiture of 1,000 shares for non-payment of the second and final call. Do it yourself. 1. A company forfeited 100 equity shares of Rs. 10 each issued at a premium of 20% for non-payment of final call of Rs. 5 including the premium. Show the journal entry for forfeiture of shares. 2. A company forfeited 800 equity shares of Rs. 10 each issued at a discount of 10% for non-payment of first and final calls of Rs. 2 each. Calculate the amount forfeited by the company and pass the journal entry for forfeiture of the shares. Rationalized 2023-24 Accounting for Share Capital 47. Illustration 15. X Limited. Issued for public subscription 40,000 equity shares of Rs. 10 each at premium of Rs. 2 per share payable as under, on application Rs. 4 per share on allotment Rs. 5 per share, including premium, on call Rs. 3 per share applications were received for 60,000 shares. Allotment was made pro rata to the applicants for 48,000 shares, the remaining applications being rejected. money overpaid on application was applied towards sums due on allotment. Sri Chitanis, to whom 1,600 shares were allotted, failed to pay the allotment money, and Sri Jagdale, to whom 2,000 shares were allotted, failed to pay the call money. These shares were subsequently forfeited. Record journal entries in the books of the company to record the above transactions. Solution. Books of X Limited. Journal. Date particulars LF. Reissue of forfeited shares. The directors can either cancel or reissue the forfeited shares. In most cases, they reissue such shares which may be at par, at premium, or at a discount. Forfeited shares may be reissued as fully paid at a par, premium, discount. In this context, it may be noted that the amount of discount allowed cannot exceed the amount that had been received on forfeited shares at the time of initial issue, and that the discount allowed on reissue of forfeited shares should be debited to the forfeited share account. The balance, if any, left in the share forfeited account relating to reissued shares, should be treated as capital profit and transferred to capital reserve account. For example, when a company forfeits 200 shares of Rs. 10 each, on which Rs. 600 had been received, it can allow a maximum discount of Rs. 600 on their reissue. Assuming that the company reissues these shares for Rs. 1,800 as fully paid, the necessary journal entry will be: Bank A, C Dr. 1,800 share forfeiture A, C Dr. 200 to share capital A, C 2,000, reissue of 200 forfeited shares at Rs. 9 per share as fully paid. This shall leave a balance of Rs. 400 in share forfeited account, which should be transferred to capital reserve account by recording the following journal. Another important point to be noted in this context is that the capital profit arises only in respect of the forfeited share reissued, and not on all forfeited shares. Hence, when a part of the forfeited shares are reissued, the whole balance of share forfeiture account cannot be transferred to the capital reserve. In such a situation, it is only the proportionate amount of balance that relates to the forfeited shares reissued which should be transferred to capital reserve, ensuring that the remaining balance in share forfeiture account is proportionate to the amount forfeited on shares not yet reissued. Illustration 16. The director of Polyplastic Limited resolved that 200 equity shares of Rs. Buyback of shares. When a company purchases its own shares, it is called buyback of shares. Section 68 of the Companies Act, 2013 provides that the company can buy their own shares from either of the following sources: a. Existing equity shareholders on a proportionate basis, b. Open market, c. Odd lot shareholders, d. Employees of the company. The company can buy back its own shares either from the free reserves, securities premium, or from the proceeds of any shares or other specified securities. In case shares are bought back out of free reserves, the company must transfer a sum equal to the nominal value of shares bought back to Capital Redemption Reserve account. The following procedures have been laid down for buyback of shares. A. The articles of the association must authorize the company for the buyback of shares. B. A special resolution must be passed in the company's annual general body meeting. C. The amount of buyback of shares in any financial year should not exceed 25% of the paid-up capital and free reserves. D. The debt-equity ratio should not be more than a ratio of 2:1 after the buyback. A. All the shares of buyback should be fully paid up. F. The buyback of the shares should be completed within 12 months from the date of passing the special resolution. G. The company should file a solvency declaration with the registrar and SEBI, which must be signed by at least 2 directors of the company. Rationalized 2023-24-56 Accountancy, Company Accounts and Analysis of Financial Statements. Illustration 19 Garima Limited issued a prospectus inviting applications for 3,000 shares of Rs. 100 each at a premium of Rs. Buyback of shares. When a company purchases its own shares, it is called buyback of shares. Section 68 of the Companies Act, 2013 provides that the company can buy their own shares from either of the following sources: a. Existing equity shareholders on a proportionate basis, b. Open market, c. Odd lot shareholders, d. Employees of the company. The company can buy back its own shares either from the free reserves, securities premium, or from the proceeds of any shares or other specified securities. In case shares are bought back out of free reserves, the company must transfer a sum equal to the nominal value of shares bought back to Capital Redemption Reserve account. The following procedures have been laid down for buyback of shares. A. The articles of the association must authorize the company for the buyback of shares. B. A special resolution must be passed in the company's annual general body meeting. C. The amount of buyback of shares in any financial year should not exceed 25% of the paid-up capital and free reserves. D. The debt-equity ratio should not be more than a ratio of 2:1 after the buyback. A. All the shares of buyback should be fully paid up. F. The buyback of the shares should be completed within 12 months from the date of passing the special resolution. G. The company should file a solvency declaration with the registrar and SEBI, which must be signed by at least 2 directors of the company. Rationalized 2023-24-56 Accountancy, Company Accounts and Analysis of Financial Statements. Illustration 19 Garima Limited issued a prospectus inviting applications for 3,000 shares of Rs. 100 each at a premium of Rs. 20 payable as follows.